I'm going to do introductions and let these two run with most of it. But my name's Eric Karlan. I'm one of the co-founders of IB Experience, and we love doing educational webinars and in-person seminars all year round. Generally speaking, we're covering topics ranging from navigating the SAT and ACT, which conveniently changed to college out of six and applications, and navigating the roadmap to college. But tonight, we're really excited to talk about a topic that is entirely not in our scope. And we're excited to do more of these series coming up and bringing in other professionals who can give us insights into different facets of the college process. Um, so I have to say that, when I introduce Pari, it's, personal as much as professional. It's really thanks to Pari that I married my wife because she was the one who dragged me out of my apartment in my early 20s and introduced me to my wife. So I'm forever indebted to you, Pari. Not why you're here tonight. I know
My
you're
pleasure.
and I'll let you, talk more about your background and introduce yourself. And Jim is, has been with us for almost a decade, talking about like filling up when I, trained Jim originally years ago as an SAT, ACT tutor at the Wegmans, in Great Valley. And now he's been our director for many years and is also a board member of the National Test Prep Association. So it's great having you both on. I'll let you guys kind of dive in from here because there's been some national news about 529s and this whole crazy world of, approaching college and finances completely differently. So, um, yeah, who wants to take it from here?
Yeah, so Perry, I'll tee you up with a question to start. So just because our audience is going to be coming in at all different places and kind of knowing the ins and outs of how these 529 plans work. So if you could start, give us kind of a big picture overview of what the 529 plan is, and then the recent change that we saw with the law passed in July.
Thanks, Jem. And thanks, Eric, for having me. Nice to help educate some people out there. So 529 plans are great savings vehicles, mainly that were used. They used to be known as like college savings accounts, right? So they were focused on college. That was the rule originally, was just to help set more aside into college savings accounts than what a UTMA or a UGMA, some people may be familiar with those, were able to do. So 529 sort of up the stakes as college has become more expensive, where parents, grandparents, aunts, uncles, family, friends could set money aside for kids' education in a type of account where they could invest it, right? So you can invest the underlying cash that you're putting into it. And on top of that, for some states, depending on the state that you live in, you can potentially get a state tax deduction on that, depending on your contribution amount. And again, every state is different. And then on top of that, when you put money into the 529 plan, let's say you have a newborn and then you're investing money over 18 years and that account, let's say, doubles, hypothetically in 18 years. All of the growth in that account, you don't have to pay taxes on if it was used for secondary education. And what's happened recently with the One Big Beautiful Bill Act is that they have expanded some of the rules around what you can actually use a 529 plan for. So historically, it was just mainly college and then any secondary school. So med school, law school, right, grad school, those sort of things you could use it for. You could also use it for some of the tech schools, vocational schools. Some international schools qualify. So you have to look at specifically and work with your accountants on what actually would qualify. But historically, it was mainly paying for tuition expenses. It was paying for room and board. What they've done now is they've expanded those eligible expenses to also include, for instance, homeschool curriculum programs. It includes tutoring services like what IB Experience offers, some licensing fees. There's also some books and other instrumental materials that can qualify, fees for standardized tests. So again, stuff that IB Experience would help with. They do dual enrollment fees for college, online education materials. Like I said, educational classes outside the home, again, sort of Ivy experiences parameter of if there's tutoring services, educational services, those things can now potentially be covered. And then they also expanded it to include specialized strategies for students with disabilities as well. And we can talk a little bit more about different types of accounts for students that might have disabilities. The other piece that changed with this One Big Beautiful Bill Act was they, in 2026, are expanding what you can use K through 12. So instead of just using it for secondary education, you used to be able to take 10,000 and apply it towards private school tuition or K through 12 expenses. 2026, that's actually increasing by double, and it's moving to 20,000 a year per child. So that's another adjustment that they basically expanded and said people are paying for other types of tuition expenses besides just college. And so they're going to expand that. A final piece that I want to mention of 529s is that they had changed the rule a few years ago where, let's say your son or daughter gets a scholarship and you don't actually end up using your 529 plan for education. There's the benefit of you can change the beneficiary on the 529 plan. So one of your kids gets a 529 plan, you could change the beneficiary to be the other kids, right? So you can use it interchangeably. You can change it to a niece or nephew. You could change it to yourself, right? So you have flexibility on changing it within your family or friends or whoever, but you can change that beneficiary. You can also now roll 35,000 of that 529 plan that's unused into a Roth IRA for the beneficiary. So let's say my son gets a full scholarship and I want to take 35,000 of that and roll it into a Roth, then I can do that. So what's happened and we've seen is that clients are contributing more. I have two kids. I'm personally contributing more to my plans because one, school is becoming more expensive, right? If you're looking at a state school, the average could be $125,000 for 4 years of education total, right? If you're looking at NYU, a Penn, right, a Ivy League school, a private school, a Villanova, it could be anywhere from 80 to 90 plus $1,000 a year for tuition. So you normally would think if you're going to try to pay for sort of an Ivy League school, you might have to hypothetically, depending on your return and how much you put in and the timing, you might have to put in close to $300,000 to get to by 18 years old, what that would actually cost, because college also outpaces inflation, right? So inflation, normally they try to keep it at 2 or 3%. For college, that could end up being 5 or 6% is what it's traditionally grown by. So that's why people are just contributing so much more. There's more flexibility, and this new act allows you to pay for, like I said, things like Ivy experience. If you need tutoring services, if you need testing services, if you need things like that, that can help you by not having to pay taxes on the money that you contributed, right? Because you're putting in a 529 plan and then using it for that expense. And Jim and Eric can talk more about this, but some of those services could give you other benefits for your child, like trying to get into a school, trying to get more grants, trying to get more benefits for them. So I'll let you guys talk a little bit about that piece.
Sure, yeah. So one of the things I'm most excited about with this change to the law where a 529 plan can pay for something like test prep is that you can kind of fund test prep with tax-free money and then potentially qualify for scholarships as a result of the test scores so that you're making kind of a pre-tax investment. It's growing. You're paying for a service with that, and then you're able to then save money on top of that. And then again, potentially transfer excess funds in the 529 to another child or use them for a broader range of services. One of the things that I wanted to share with everyone is just how powerful standardized test scores can be in the scholarship process. So what I'm sharing here is just a webpage from the University of Alabama, and this is just an example. But for 2026 out-of-state freshmen, they have automatic merit scholarships for students who qualify with a certain test score and a certain GPA. And you can see that, of course, they have full scholarships for students who get perfect scores. But there is a broad range of test scores that are going to qualify students for very strong scholarships here. This is per year, right? So multiply these numbers by four for the amount of money that you're going to end up saving over, a 4-year college career. And you can see, 25 on the ACT or 1200 on the SAT, assuming your GPA is going to be above 3.5, is going to net you $24,000 over the course of college. Again, if you're targeting the University of Alabama. Now, not every school has what we call a merit aid grid, which is to say a table with a GPA and test score that shows you exactly how many dollars you have. But many schools have similar systems that also include subjective elements like essays, like other factors in the application. The University of Pittsburgh, we know, has a very similar system to this just by comparing awards that our students have gotten over the years. They tend to stratify their awards by test scores and GPA, but they also have, for instance, a test optional path to getting scholarships. So their process is a little murkier. It's not as transparent as University of Alabama's. Generally speaking, the schools that have these kinds of programs tend to be the larger southern state schools. They're really big on having these. I know Florida Atlantic, Ole Miss, Auburn would be other examples of schools who have similar programs where you can just look up on the internet exactly what test score gets you exactly what amount of money. I'd also like to point out that for these scholarships, you can actually decide to go for the test score after acceptance. Most of these scholarships, I at least know this is the case for Alabama. You'd always want to check school by school, but they accept scores through June of senior year. So you could get in with whatever score that you apply with, and then you think, oh, well, I got a 1280, but I'm a little older, a little wiser now, end of senior year. I've got a lot of free time because my grades don't matter as much anymore. I bet I could get 20 more SAT points and earn myself, $2,000 times four over the next 4 years. So these are really great opportunities, again, when you can leverage tax-free funds or tax advantage funds, I should say, in the first place from a 529 plan to do it. Pari, bringing it back to you, we had a specific question in the chat, so I'll ask that first, which is, does the new law allow the use of 529 plan funds for college application fees? So the actual fee that you submit when you apply. And I'm going to pair that too with the broader question of, with the expansion of these 529 categories, we're going to see more and more of these questions. Does a 529 plan, cover X? What would be your kind of best advice to someone as a resource to figure out, what is the best way to know if this or that expense can be covered? Is it consult with a professional? Is there some kind of online compendium people can go to? So go ahead and shoot with the specific and the general question.
Yeah, so I believe the new law does allow for enrollment fees and for application fees to be covered. All of this, you would always want to check with your accountant, right? Because at the end of the day, this is all going to flow through when you do your tax filing. So again, there's always going to be nuances with the tax code and what some accountants will feel makes sense to deduct and other accountants won't. So I would always refer to your accountant for any type of deductions, planning, things like that, because they're the ones who are actually filing your tax returns, right? And applying some of this. Your financial advisor, if you work with one, they would be the person to help set up the account, help plan for how much you need to contribute if you were planning to pay for school. So as an example, we have clients that say, I want to pay for a pen. And so we know that's going to cost X, and I'm biased because Eric and I went to Penn, so I use that as an example. But we look at what the cost is, we inflate that out based on what we expect it to be, and then we can back and do, okay, if you want to make a pen sort of payment, this is how much you have to contribute. Now, something I didn't mention is how much you can put into 529 plans, right? So normally we have clients that are making contributions to use what's called their annual exclusion. So you would set up a 529 plan, you would gift, for each person, you can gift $19,000 to any other person or entity. So I can take $19,000, my husband can take $19,000. So combined, we could take $38,000 a year and move that into a 529 plan as part of our annual exclusion, right? It doesn't count as a gift. If you go above that, what you will need to talk to your accountant about is filing an additional gift tax return, because technically, even though you're the owner of that account, you're moving it to someone else because your children or whoever would be the beneficiary. So that's where your account would also come in, going over that annual exclusion number. Now, 529 plans allow for what's called a 5-year catch-up, where you could take that and you could make a 5-year contribution of that 38,000. So 5 years of 38,000 is 190,000 is what you could put into a 529 plan in 1 year. And then the next 5 years, you wouldn't be able to make any contributions, right? So it's a 5-year catch up of making a lump sum contribution into the plan. Again, if you go above some of those numbers, and always check this with your accountants, but you would then have to file a return. So advisors will help you plan for how much to contribute, when you should be contributing it, and also how it should be invested, right? So if you want to be, I would suggest, if you are comfortable with risk, you might want to be more aggressive as your kids are just born and younger. And then as they get closer to college, it might become more conservative because you're going to use those funds, right? So if you have a goal and the goal is 1 or 2 years out, you don't want to put 100% of it in the S&P 500, because what happened in March and April, where the market went into a bear market in a few weeks, right? If you needed that money, you'd be selling when it's down. So as far as planning goes, your advisor will help you figure out how it should be allocated and then help you as it gets closer to that goal. Your accountant's going to work with you on, depending on the state, making those deductions, right? So for instance, Pennsylvania, the annual exclusion amount, that 38,000, I can deduct it off of my state taxes, right? So it only impacts state, which is 3.07, but it's still something. Other states like New York, the cap is around 10,000, right? So some states, you don't get any deduction. So it really just depends on where you live for that state tax deduction. But at worst case, your money is growing potentially tax-free if it's used for these qualified expenses. If you don't use it for qualified expenses and you pull it out, you have to pay a 10% penalty and then income tax, right? So the biggest downside is that 10% penalty. If I was to put it into an after-tax account, I'm still paying taxes on that growth, right? You can't just, you make $1, the government wants you to pay tax on that, right? So that's the same idea if you were to put it into an after-tax account. Put it into a 529, the benefit is you don't have to pay that tax on the growth that you've made. So I think that answered most of your questions and then some, but hopefully that was helpful.
Yeah, we got a quick follow-up question in the chat, which is just to ask for the one-word answer. Does the law now cover the college application fees with
Yes,
529
I
funds?
believe
Okay,
so.
one-word answer is yes. But yeah, obviously there's a lot of nuance and complexity to these things. So we appreciate all that
Yeah, I
context.
mean, and there's still, like, I don't know if anyone's read it, but I would always double check again with your accountant to be sure that everything that I'm saying is true. So, double check on that, but they consider enrollment fees as a part of that.
Awesome. Now you mentioned, double check with your accountant to make sure you're right. So my follow-up question to you is what happens if you're wrong? So we know certain things like test prep and tutoring are going to be covered by the 529 plan. What happens if you somehow cover an expense and the law says actually it's not covered?
Good question. I mean, again, more of an accounting question, but realistically, they might have to file an amended return. You might have to return the money back to the plan, or it might be considered a penalty where you would have to pay that 10% plus taxes on the money that you took out for that expense. So
Am I right
again,
in my understanding that that would only really be the case if you were somehow audited?
most likely,
Okay,
yeah. Yeah, I mean, someone would have to point it out
right.
realistically for that to happen, but you have to think about how they've expanded the law. We have clients all the time that call around how much if they're, for instance, if their kids are living off campus, right, versus living in a dorm, what is qualified if they're renting an apartment in New York City, right, versus living in a dorm in New York City. So this, again, is where maybe we should have an accountant on this call, but this is where an account would come into play to say, okay, you can Normally, most accountants will say whatever the dorm expense is, you can use that out of the 529 plan because that's covered. But if your rent is double that, you may not be able to fully pull it out of the 529 plan to cover that expense. So a lot of nuances depending on the state, depending on what the school has that they, their expenses are, right? Because there's so many variables for each student. And then there's a lot of variables in everyone's tax returns that come into play. So that's why it's important if you're going down this road or your kids are getting closer to school, you might want to sort of strategize this around, yes, this I'm going to assume will be covered and this I won't.
Understood. Now you mentioned that 529 plans are something that a parent can open. Is there a way for other relatives to contribute to the plans?
Yeah, so anyone can contribute to it and anyone can open a 529 plan. So like for instance, we have a lot of grandparents that open 529 plans for their grandkids because, and you guys can probably speak to this more than I can around when colleges look at applicants for financial aid purposes, right? Looking at the reason why people like 529s is because it's technically the parent's asset. It is not the child's, right? So as you go, and my understanding, I'm not a financial aid expert, but when you're applying for financial aid, the thing that schools look the most at is what's actually in the child's name, right? So if you have a trust, if you have assets in the child's name, a savings account, we tell clients to not have accounts in their kids' names, right? There's not really that much of a benefit if they felt like they would qualify for any type of financial aid. So that's the first thing to think about. And then using a parent for 529, mostly, I believe, parents' incomes are given a higher percentage weighting for financial aid than a 529 plan would. So putting in a 529 plan is going to have a much smaller impact than having it in the kid's name or a kid's savings account. And then finally, if you take the next layer and you have a grandparent that has a 529 plan for the child, it's really not considered at all, right? Because it's not even in what the family would have to put in because the kid is not an owner of that account.
Right. All right. We had another question come in through the Q&A here. So if I spend $5,000 on test prep for ACT, how can I get the money from the 529? For my kids' private school, I have the 529 company pay 1,000 or $10,000 directly to the school from my child's 529. Would it be the same for test prep? And when do these new changes take effect?
The new changes took effect July 5th. So they're already into place. The $20,000 K through 12 expenses starts in January. So that piece of it for K through 12, like tuition, you can't go over that 10,000 for this year. For the reimbursement, you can, depending on where your 529 plan is, you can get reimbursed, right? So if you pay the expenses yourself, then you reimburse yourself from the plan. We do the same thing. We use American funds a lot. That's where my 529 plan is. I like the investment allocation and the choices that they have. We have Capital Group / American Funds send the payments directly to the schools. So using the child's student ID number and everything, and they pay the schools directly. So it never really goes back to the parents. But we have some people that want to they pay the payment and then they reimburse themselves.
So it sounds like paying it up front and reimbursing yourself is kind of the more straightforward option that'll work kind of anywhere. And then some schools are set up to take the payments directly from the plan administrators.
Exactly.
Awesome. Cool. And then are there any potential downsides when it comes to overfunding a 529 plan? Or what are the consequences?
It's that 10% penalty in taxes if you don't use it for any of these qualified expenses, right? So the way that I think about it, and I tell clients to think about it, is money I'm putting into the 529 plan, I don't think of as mine anymore, right? I think of I'm moving that to the next generation. That's going to my kids and it's never coming back to me. So I think that's the smartest way to think about it is it's not really your asset anymore and you're probably not going to pull it back. Worst case, I would change it to my kids, right? Like I'm not expecting to take that money back. But if you needed the money back, there are exceptions to that 10% penalty for certain hardship reasons. So you'd have to, again, talk to your accountant about what would actually qualify, because these are IRS guidelines. But there are exceptions like death, disability, things like that, where you can pull the money out without having to pay that penalty. And then speaking about disability, just sort of touching on this, there is something, and a lot of people aren't familiar with it, but it's called an ABLE account. So Achieving a Better Life Experience Act of 2014 put into place these accounts where you can basically set up a tax advantage savings account for people with disabilities. So the new law had adjusted this to cover more than what traditionally ABLE accounts were allowed to. So that was one of the other positive changes to it. But it's basically a tax advantage savings account that people with disabilities can have, where they can save for basically life expenses without losing eligibility for other benefits like Medicare and SSI. And certain balances you need to keep to qualify for certain benefits if you're disabled. So again, working with an accountant on that piece is especially important. But what they've done is, we've had some clients that have children with disabilities. And so we've set up over the last few years ABLE accounts where they had historically funded a 529 plan. And so they assumed that they were going to be paying for college. Life happens, things change, and now they're funding other things. So you can transition that 529 plan into an ABLE account. And so again, talk to your accountant about what you're able to do, what your tax code looks like. But moving it into that, normally to qualify to use an ABLE account, the easiest thing is if you're already receiving some type of SSI or SSDI, then you would be qualified. What they did originally was this was for people that were disabled or considered disabled younger than 26, right? So you couldn't set up an ABLE account if you were over 26. The new rule, I believe, is expanding that into the 40s. So now it's 46 is what you're able to have this account set up and to use that for your expenses. So they would consider any qualified disability expense to be part of that ABLE account. So that includes like food, education, legal fees, housing. I think it's transportation, funeral, burial costs, financial management, those type of services, admin services. That's all qualified under an ABLE. So you can see it has a lot more capacity than a 529, which is more education driven. So the other thing that the new bill has expanded on is how you could meet that criteria. So if a doctor, I believe, deems that you're disabled or that you have some type of disability, then you would qualify as well to set up this ABLE account. So again, expanding on that. And that contribution limit is same idea as the 529, that 19,000, right? So what we've had clients do is over the years transition 529 plans into ABLE accounts, right? Before their kids are at the age where they may not have as much flexibility to do that, or before they actually need the costs. So those are just one other nuance. It doesn't apply to everyone, but something to talk to your advisor about and to your accountant about if you have children that might have some disabilities.
Awesome. Thank you for that. And then just to clarify, because you mentioned some of the changes went into effect right when the law was passed, others are going to effect at the beginning of the new year. We got a follow-up question. Is ACT test prep able to be paid for with 529 plans effective now in August 2025?
I believe so, yes. I believe
Yeah.
that those additional changes came into effect that July 4th date. It's just the $20,000 change to increase K through 12 is January 1st, 2026.
Awesome. We got another question in the Q&A, Pari. One a little more personally directed to you, which is just, sort of on the lines of how do you know so much about this topic? Tell us a little bit more about what you do for a day job and Salon Magura more generally.
Great question. So this is all I've done for the last 17 or 18 years. So when Eric and I were in college, I started interning for Smith Barney, which no longer exists, but then Morgan Stanley bought them. So my whole life has been wealth management. I have a practice now at RBC where myself and my business partner, Rob, help clients with all of these things. So we help people with really anything with a dollar sign. So figuring out college savings, figuring out, their next home purchase, looking at retirement planning, holistic financial planning, right? So we look at every aspect, insurance, disability, all of those things, long-term care, and we make sure that our clients are comfortable and that they know how to accomplish their goals and what they need to do step by step. So my job is to hold them accountable to reaching their goals, right? To not outliving their money, to making sure that it's invested the right way, and then we invest all the money for them. So this is just what I've been spending a lot of time on, just like Eric and Jim, right? They could tell you everything about test prep. This is sort of what I do. And the hard piece of it is, which is why I keep saying refer to an accountant, is we don't know all the rules and you can see how often the rules are changing, right? So that's why it's always important to just double check any of this that you're hearing with an accountant that's going to actually know your specific situation, or your advisor that knows your specific situation, because some of these things may apply to you and it may not. But this has just been a lot of education. I have my CFP, which is my Chartered Financial Planner, and my CRPC, which is specific for retirement. So I've taken some secondary education, to be able to learn even more about the planning side of it. But this is what I do all day long, which is why not everyone on this call is expected to know all of these things, because you guys don't do this all day long, right? I wouldn't expect you
Yeah.
to. But that's why it's so important to work with someone that you trust and that you think is going to steer you in the right direction, because there's a lot of people in my business that are not going to do that and are not going to do what's in your best interest. So just find someone that you trust to work with on this stuff.
Awesome. I have one more question here in the Q&A, and maybe you can answer it, or maybe the answer is ask your accountant. We'll see. But the question is, our daughter's taking an SAT prep course now. It's a summer course, so happening currently. But this parent paid for the course in February of 2025. Can this parent submit for reimbursement for this SAT course from a 529 plan?
Yeah, that's an accountant question. I mean, I would assume there's probably a way to make that work because it's in this tax year. And the rule, I'm assuming, is going to apply to this tax year, because they're not going to be able to track, like, you paid that in February and we started the rule in July. So my soft answer is yes. I'm assuming you would be able to get reimbursed out of that. But something else just to like sort of call out in this scenario is that if you have been saving money for college and you don't necessarily know where your kid's going to school or how much it's going to cost, you may not want to deplete it with K through 12 expenses, right? Like some people might say, I want that money to grow for as long as possible in a tax deferred way so that I can maximize the growth that's going to be tax free, rather than taking money out when your kid, if you're only able to put 190 grand in as a lump sum, right? And then you start pulling money out when your kid's in kindergarten, and then you can keep making contributions from there. That money's not going to grow as fast because you're constantly putting money in to pull it back out. So it may make sense to try to defer as long as possible if you can pay for some of these things out of pocket. But the other side of the coin is, if you overfunded it or you have enough, then obviously pull stuff out for ACT test prep and whatever else. But
Right.
my opinion would be to try to keep it in there for as long as possible if you know college is going to be a big expense.
And I suppose the advantage that parents have when it comes to things like test prep is your student's going to be 16 or 17 years old, pretty close to college
You'd have
years.
a
So you're
better
going to have a pretty
idea.
good idea, right, of what the account will look like to be able to make
Exactly.
the right decision. Yeah.
Exactly.
Awesome. So we've exhausted all of our audience questions today. So if anyone throws one in the next 20 seconds, we'll hit it. But otherwise, this is where we'll say farewell. So I've dropped a link to Pari's company in the chat. We also send a recap email out for all of our webinars. We'll include Pari's contact information there if you have any questions for her. We will be posting this webinar to YouTube, so if you want to share it with friends or a spouse who couldn't make it tonight or anything like that, feel free to do so. Thanks so much for giving us your time tonight over Taylor Swift. We really appreciate that, and we hope to hear from you all soon.
Yeah,
Take
we
care,
appreciate
everybody.
you, Carrie. Thank you.
Thanks, guys.
Bye bye.
Bye, guys.